Are you self-employed and worried about getting approved for a mortgage, or maybe you're trying to get approved for a mortgage and it's been a bit of a struggle? If that's you, you're going to want to stay tuned, because in today's video, I'm going to talk about self-employed mortgage approval. So how to get employed, how to get approved if you're self-employed. And so the path to home ownership, if you're self-employed, is more difficult. It's more complicated, but it's not impossible. And so in this video today, I'm going to share with you my top tips for those of you that are self-employed on getting pre-approved for a mortgage, as well as some common things to avoid. And so we're going to jump right into this thing. The first thing that you need to understand is that when you're self-employed, there is more documentation and there is more hoops to jump through. Now, this doesn't mean that the actual requirements of the loan are different for you. So you don't need to have a higher credit score than someone who's not self-employed. You don't need to have a larger down payment from someone who's not self-employed, unless you're using a non-QM program, which we'll talk about more. But for standard traditional programs like FHA, VA, USDA, and conventional loans, the requirements aren't any different. It's the documentation that's different. And so when it comes to being self-employed, there's going to be more documentation. There's going to be a different income calculation. We do not use your gross income like we would use for a standard W-2 borrower. And so one of the things that you need to know right off the bat is how your business is structured determines what's needed. So if you're a sole proprietorship or you're an LLC, then it's the documentation required is only slightly more. However, if you have a partnership, if there are other investors, then we're going to need additional requirements. It's not just going to be your personal tax returns, especially if you own more than 25% of the company. Then you're going to talk about business returns. You're going to talk about profit and loss statements. You're going to talk about K-1s and different things like that that are going to be needed in order for you to be able to get your income calculated properly. So how is income calculated for a self-employed mortgage? Well, it is using your net income based on your tax returns. So on your tax return, like say for instance, you're a sole proprietor or you're a self-employed LLC, then you're going to have a Schedule C tax return. If you don't have any investors, if it's just you, which is most of the businesses out there in the world today, if it's just you, then you're going to have a Schedule C on your tax return. That is where your income is going to be filed. And so the lender is going to look at the Schedule C from your tax return. They will see your gross receipts or your gross sales, but on line, I believe 30 or 31, that's going to be your net sales. So it is not gross income, right? For everyone else that applies for a mortgage, when it comes to a W-2 borrower, they get to use their gross income. For the self-employed, not only do you not get to use gross income, you have to use your net income. It's also average. So for most of you, especially if you're going to do FHA, VA, or USDA, then you're going to need a 2-year history of tax returns to qualify for a traditional mortgage. Now, sometimes if you've been in business over 5 years, or if you have particularly strong credit, you may get away with only 1-year tax returns, but the lender is only going to know that once they look at your file. And so they're going to take your net income. That means all of your income after deductions, not before, and they're going to apply that as the monthly income that's being used to qualify you for the home loan. Now, an important thing to understand is that lenders can add back in depreciation because those are not real expenses. And they can also give you credit for mileage that's been deducted. And so sometimes that makes the difference between qualifying and not qualifying. And it's one of the main reasons why you want to work with a professional who's helped self-employed borrowers before and who understands what they're doing, so that you don't apply for a mortgage and get denied when it absolutely could have been approved, because we see that type of thing happen all the time. So that's kind of the main difference, is that you're going to need 2 years of tax returns for traditional mortgage programs, and we're using your net income, not your gross income. Let me give you some tips now for getting a mortgage while self-employed. Number one, you want to show a steady income stream. Okay, I know that taxes suck, but if you want to get approved for something other than a bank statement loan or some non-QM program, which we'll talk about in a second, then you're going to need to show a steady stream of income. You can't show a loss. If you're showing a loss and it's not as a result of depreciation, it's because you're actually operating at a loss, then the lender is going to go, they're not making any money, you don't qualify for the loan. Just because you have $450,000 a year in gross sales, if you show a net loss of $100,000 or even $10,000, it's going to be difficult to qualify you for the loan, again, unless we can add back in the depreciation. So you're going to need that 2-year average. So if you show a loss one year and you make a little bit the next, it's going to be difficult. Number 2, focus on building your credit score. As a self-employed person myself, I know how difficult it can be when you're waiting on people to pay you and all these different types of things. Sometimes self-employed folks live on credit cards and different things. You want to focus on getting your score up to give you the best options available for self-employed borrowers. And then number 3, save up for a down payment. Now you can use business funds for your down payment. So if that's something that you want to do, that is available, but you need to have a down payment available when you're self-employed. It's just going to give you more options unless you're a veteran, and then you don't need a down payment. And then number 4, I already said it, working with a knowledgeable loan officer. A knowledgeable loan officer is going to understand, based on your business structure, what documents are required and how to give you the most generous income calculation that the underwriter is going to accept. The problem with rookie loan officers is they don't know, and they put something in there, and then now they're telling you that you can't be approved, and you expect them to know what they're doing, and they don't, and now you're having to go to multiple different lenders to find somebody who understands how to operate a business and how a business tax return is supposed to work. And so, but none of that can overcome showing a loss. So if you know you're going to buy, if you know you need to buy a house, or you know you're going to refinance, you need to get your income in order. Now, let me just take a second and talk about these non-QM programs. And predominantly what I want to talk about is bank statement programs, because that's most of what gets pushed for most self-employed borrowers. And so a bank statement program is different. It's not utilizing your personal income from your tax returns, but from your bank statements. And so what happens is the lender collects your bank statements, usually for 12 or 24 months, and they calculate all of the income that comes into the account. And then they have a factor that they take out of that for expenses and everything else. And sometimes that can help you qualify for a mortgage when you otherwise would not have qualified. And it can be a great way to get you into a home, to get you into a mortgage, if you're okay with paying a higher interest rate, because the interest rate is going to be 1% to 2% higher, typically, maybe more, when you utilize one of these programs, because it is a non-qualified program, meaning it doesn't come under the restrictions of Fannie Mae and Freddie Mac, but it also means that the lender is less protected. And so they do have higher interest rates. They can be riskier loans for the lender, which is why they have higher interest rates. But sometimes it's cheaper to pay the higher rate than to, have a huge tax bill. Now, you should be filing your taxes accurately. So if it's not a real write-off, you shouldn't be doing that. But sometimes these non-QM programs work for folks who are just getting started up, and they have to write a bunch of stuff off because they just got their business started, or it's been, in the first couple of years. So bank statement loans are an option. We do offer them too. But they do come with a higher rate. They do require typically, I believe, 15, 20, 25% down and a much stronger credit score than, say, an FHA loan. The other one would be those of you that are self-employed technically, but not really, like you're 1099 by only one company. There are programs out there that are 1099 only, where they would only look at your 1099s, and that's how they would determine if you qualify for the mortgage or not. And so those are just 2 examples of non-QM programs if your tax returns aren't meeting the requirements that you could look into. But for everyone else, you need to start showing a consistent, steady stream of income 2 years before you need to buy a house, right? And so that's the 4 tips. Here's some common mistakes to avoid. So you don't want to give inaccurate or incomplete documentation. And so I know that oftentimes when you're self-employed, the loan officer is going to be asking for a lot of information from you, and it can be very stressful. But you need to give complete documents, because they're not going to be able to get the full picture without complete documents. You also want to avoid too many write-offs, especially if you know you're going to need to get a mortgage. Number 3, you need to keep business and personal funds separate. This is predominantly an issue for those of you that are sole proprietors, because once you get an LLC, you kind of get an account and do all these things. If you're a sole proprietor, you have to keep your business and personal funds separate. It makes it a lot easier to determine what's going on. And when the underwriters start asking for documents and it's all mingled together, it just becomes a mess. Just as a general business practice, it's also good to keep your business and personal funds separate. And then number 4, avoid not being prepared for the underwriting process. And so what does that mean? That means everything we've just talked about. Know going in what they're going to expect from you, what they're going to look for from you, and how that's going to be handled, that it's going to be average and it's going to use your net income. And that's going to save you a lot of frustration later on from feeling like you don't know what's going on or like you're going to get denied or whatever happens. And so self-employment doesn't have to mean you can't purchase a home. It just means it's different. And when you understand how it's different and what the requirements are, it enables you and empowers you to get done what you need to get done. Because there's one thing I know about you self-employed folks, being self-employed myself, you're very resilient. And whatever needs to get done, it's going to get done. And so I believe you'll do it, and I believe in you. If you have any questions about mortgages and self-employment, drop a comment. I'm happy to answer it. As always, please, if you enjoyed the video, like it and subscribe to the channel, because most of you aren't. That way YouTube will know more people like you enjoy watching my videos, and I will talk to you soon.